Hi, this is Sandra Cho with Pointwealth Capital Management, and today I'm going to be going over January 2024. January proved to be resilient and bounced back from a slow first half. The S&P 500 finished the month up 1.7, the Dow up 1.3, and the NASDAQ up 1%. Much like 2023, large cap growth stocks led the way, with the largest gainers being communication services up 4.8 and technology up 3.9%. NVIDIA continued its incredible run, finishing January up a stunning 24%. Developed international markets also did well, with EFA up 3.22%. On the flip side, emerging markets, dragged down by China, turned out a disappointing negative 4.6% for the month. The Ag finished January basically flat at negative 0.3% as the Fed tempered rate cut expectations. However, we do still see bonds as being attractive due to favorable pricing and coupons at levels not seen for over a decade. January ended with the conclusion of the first Fed meeting of 2024, with Powell signaling that the Fed's rate cutting cycle will be slower than first anticipated. He basically insinuated that a cut at the March meeting was relatively unlikely and continued to mention that the Fed will be data dependent. This led to a sharp sell-off in the markets following his commentary. Here at Pointwealth Capital Management, we have always held the belief that March was too early to expect a cut, with all things considered equal. With over 40% of the S&P 500 having reported Q4 earnings, the overall results have been mixed. 75% of earnings that have come in beat expectation, but overall earnings are tracking flat year over year. Large tech companies such as Microsoft and Google have seen their stocks drop despite solid earnings reports. The Magnificent Seven stocks seem to be losing steam. Q4 GDP came in at an annualized rate of 3.3%, well above Wall Street's 2% estimate. This gave investors continued optimism about the resilience of the economy, even as rates stay inflated. Continued consumer spending remains strong, with December online sales growth coming in at 9.7% year over year. People are still spending, especially at restaurants, which had 11% year over year growth. And in other positive news, the PCE, which is the Fed's preferred inflation gauge, continued to slow in December to 2.6% year over year, and consumer confidence rose in January to its highest level in 2 years. Not all news was good, though. Private payroll growth declined sharply in January, possibly signaling a slowdown this year. While nothing is guaranteed, a positive January has historically been a bullish sign for stocks. Since 1950, the S&P 500 has posted an average annual return of 16.8% during years that had a positive January, like we had last month. Let's see if economic and market data can continue to move in the right direction during February. And don't forget to leap. See you next month on Pointwealth Capital Management, Pointwealth Perspectives.